All right, so learning objective 4 gives us a look at something called a multi-step income statement, which is one of my favorites. um, for the most part, it has more detail, which is why it's a favorite. For the most part, what we've been using have been something called a single step income statement, which basically looks at the total revenue, subtracts out the total expenses, and gives you net income. And the multi-step is a little bit more detailed, as you'll see soon. But you're sort of used to the single step. And this is an example of a single step income statement from Recreational Equipment, Inc., REI. Again, the numbers are in thousands that you see here, and they're for 2 fiscal years side by side. Fiscal year ending December 28th of 2013, and then a year and looks like 5 or 6 days later, the end of another fiscal year, January 3rd, 2015. Okay. So here your revenue is listed as, here it is, net sales. I told you it was so important to know. You're going to see net sales almost on every single income statement. And here you went from, these numbers are in thousands, so you have to add 3 zeros. So we went from just a tad over 2 billion, because you got to add 3 zeros here, to about 2.2 billion. So the increase was quite good. I mean, when retail goes up almost 10% in sales, that's really damn good, particularly today. And then you have a list of expenses. I want you to notice something, and you're going to see this over and over again. The cost of goods sold is the largest expense for merchandisers. It's more expensive than labor costs, which are your second largest here. And because the cost of goods sold is so large of a cost to businesses, that they try to do everything they can to reduce that cost. And what we've been seeing over time, in order to reduce this cost of inventory, many stores, many companies have been relying on purchasing those goods from countries that have much lower costs. And so we have lost a significant amount of manufacturing jobs in some of the basic industries like clothing and footwear to places like China, but now, also like Vietnam and other places that are reasonably inexpensive. And the reason that companies like Walmart and others prefer that is this expense line right here. Okay. They know that if they can get their cost of inventory down as much as possible, then they're going to be able to get a net income. They're going to be able to squeeze out a profit. And again, cost of goods sold, when you look at this in every single income statement you see, cost of goods sold is going to be the largest expense. Okay. So that's why there's so much emphasis on outsourcing as much as possible for other places like China to produce. As a matter of fact, let me just throw this out. Walmart has and has had since the 80s and certainly 90s, has had a very close business relationship with manufacturers in China. Walmart imports a lot of products to their stores. They are the largest retailer. 80% of everything Walmart imports into the country for sale in its stores is coming from China specifically. And so, and the reason there's such an emphasis on all of that, and Walmart was really just smart in trying to lower the cost of goods. Again, lower the cost of goods so it can make a profit. Cost of goods and expense, right? And so that's really the impetus for you've seen this mass exodus of some basic industry um, going to places like China. It's because of the cost of goods sold. It really is. Labor costs are not as much of an issue, but for a lot of retail stores, they don't want their labor to be unionized. Walmart has done everything that they could possibly do to fight really almost now a 30-year battle um, to try to get its labor force unionized. And that has failed. That has failed. And the reason is too is because, again, it's the second largest expense that retailers like a Walmart have is their employees, their payroll. So they want to keep that cost low. So look at the two biggest costs they have, and now you understand why retail A relies so heavily on imports from places like China, and B pays so low for a lot of its workers. It's related to these two lines on their income statement. Okay. Of course, revenue minus expenses will give you a profit. Here's your net income here. And as you see, there's not a lot of profit in retail. Not a lot of profit in retail. When you started with $2.2 billion, remember, these are numbers are in thousands, we're adding 3 zeros. When you start with 2.2 billion in sales and you end up with about 44 million in profit, you're not keeping a lot of what you collect. You're not keeping a lot of what you collect. As a matter of fact, most retailers are only keeping 2, 3, or 4% on every dollar as a profit. So every dollar you give to Walmart, for example, 97 cents of that dollar is eaten up in expenses, leaving roughly about 3 cents out of every dollar for their profit. Okay. So, of course, they make a lot of dollars. Walmart's quite huge. But in essence, it's small potatoes. And that makes controlling their costs even more important, which puts a lot more pressure on manufacturers to use overseas labor and factories to keep the costs down. It also makes it exceptionally difficult for retail employees to unionize in these big retailers. So the multi-step income statement breaks this down even more precisely. First of all, what you'll notice is the first thing it breaks out is that gross profit. And remember, you need to know sales revenue minus cost of goods sold will give you your gross profit. So that's really critical. And the multi-step income statement provides that as an obvious answer. The second thing that you'll notice, the second thing that you'll notice here is it'll provide you with, remember the word income and profit and earnings all mean the same thing. It'll provide you with how profitable is the operation of the business, okay? And as these corporations get larger and larger, they do a bit more than their main business. So for example, you've probably been to the Walmart in Fishkill, that's the closest one to us, or maybe the one up in Kingston or whatnot. And as you walk into the Walmart here, you'll notice a couple of things. One, there's a McDonald's in the Walmart. There are a couple of other places like a hair stylist and so forth. Some Walmarts might have a bank or other types of things, a Subway in them. Well, Walmart's main business is its main operation is selling goods. And that's how we should be measuring the success of the company. Are they selling goods, which is their main business, and profitable from it? The fact that they rent space to McDonald's so they're a landlord, doesn't mean that that's their main operation. Their main operation is selling goods. They might make other money from other things that they do, but it's not their main operation. So what the multi-step income statement does is tell us how profitable is the main operation of the business. Okay. It breaks it out from their net income. Okay. Because again, the last step is net income, which is everything else that's involved. And you'll see on the multi-step income statement, there can be a lot of things that interfere with the profits of the actual business, the main business, and what's left over in net income. Okay. So this is going to be the interesting part. So here is the recreational equipment, the same exact income statement, but now it's presented as a multi-step income statement. Okay. And look at the key items, right? The very first thing it does is break out the gross profit, which, as you know, is net sales minus cost of goods sold. So this is the very first line that's different on a multi-step income statement that tells us, again, what the revenue is, what they collected from customers to sell their products. Cost of goods sold is what the products cost them to sell it to the customer, right? And the difference is the gross profit. From that gross profit, all of the expenses have to be taken away. Well, first of all, let's look at the expenses that are specific to operating the retail store. So this REI, if I didn't explain it last time, is sort of like a combination of like a Dick's Sporting Goods and a Cabela's or a Modell's kind of wrapped into one. So it's basically a retail sporting goods type of store, more outdoors emphasis, but nonetheless, it looks like walking into any other sporting stores. So and that means their main business is selling those goods related to that. So the operating expenses for that business have a total. And now we get our second piece of information, the profit from the main operation of the business. The profit income, remember, same as profit, same as earnings, all means the same. The profit from operating the business, this company is quite profitable, just from the operating of the stores themselves. They have a profitable business. They're making almost $182 million profit from 2.2 billion in sales from their stores. Okay, much higher than last year's, the previous years, right? But now they do other stuff. Remember, I said they do other stuff. Walmart is also a landlord to the McDonald's in Fishkill because they rent space to McDonald's in Fishkill. So they're making other money from that. They also have other expenses. I'm sure as a landlord, they promised McDonald's a few things, and that costs money. So notice there's an other category that shows other revenue and gains and other expenses and losses. So this is other stuff that is happening to this company that's not specific to them selling their products, but other things that they're engaged in that create revenue or expenses, gains or losses. And as you see here, their largest piece here is something called a patronage refund. And that patronage refund is eating up, if you look at both years, most of that profit from operations. Then, of course, they have to pay or have an allowance for income tax expense to get to that bottom line of net income. So when you look at a multi-step income statement, there's interesting questions. Is $44 million the real story of this company that sells $2.2 billion in goods? in this fiscal year. Well, no, more along the lines, it's more profitable than that just by running the business. However, because they have promised these refunds to, and I don't know what patronage refunds are, but we would have to read about them in the annual report, that's taking up much of the profit, right? That particular expense is taking up much of this particular profit, leaving them with what looks like a smaller profit. But this store, REI, in essence, if you look at it just from the operations perspective, it's a profitable business. It's a very profitable business. It's doing well, better than the bottom line would suggest. And that's what a multi-step income statement, why it's important to know about. Okay. Your book goes over and explains the 3 lines. Again, I told you about this last time. Sales revenue minus returns and allowances minus discounts gives you the net sales, right? Very important to know because you're gonna need to see that. Gross profit is listed, net sales minus cost of goods sold. All your operating expenses are to operate the business. Then you have something called non-operating activities, other things the business is doing that's either making them money or creating expenses for them, or either resulting in a gain or a loss from what they're doing. And again, your book explains some of these in a little bit more detail. Okay. And then, of course, your net income, the bottom line. So again, even when you look at PW Audio, their main business created 460 in sales, 144 in gross profit, $30,000 from running the main business. But they have other things that they're doing that created a little bit more of a profit, right? Because this is their original profit, 30,000. All the other stuff actually created a little bit more of a bump. 31,600 is their real profit before they take away their taxes. So that means the net income is boosted a little bit from their other activities. Okay, just a little. But as you saw with REI, their net profit is really it's actually quite smaller than how their business is really going. Business is actually going much better than what the net profit would show. Okay, so that is a very important concept that you'll be studying a lot. Okay, so then they're talking about something called a comprehensive income statement. And comprehensive income is really about items that are not normally included when we determine net income. For example, here, PW Audio has an unrealized gain on their investments. Well, that technically represents something more comprehensive than our income statement would normally show. And so it's reflected on a comprehensive income statement. It wouldn't be reflected on the multi-step or single-step income statement. Okay, a little less important than the one that we just went over, but this book explains it. It's important. So again, one of the things that you'll be doing that's going to be take a little bit of time, but not a ridiculous amount, is setting up the multi-step income statement. And here we have an example for an arts center corporation that ended their year in December 31st, 2017. And they're going to ask us to prepare the multi-step income statement. You kind of know how it goes, right? Sales revenue minus sales returns allowances, which there are none, minus sales discounts, which there are, will give us our net sales, right? So the first step is net sales. Then from net sales, take away your cost of goods sold, and that'll give you your gross profit. From your gross profit, you take away all your operating expenses, and that'll give you your earnings before, that'll give you your earnings from operations or income from operations. Then you have this other stuff to deal with. Other revenue is larger than other expenses, so it's going to boost their profits by the difference. And you're going to see this again, and you have to take taxes out as well. So you're going to see this on the on this. So here's your gross, your income from operations, 108. Then you add your other revenue and gains, subtract out your other expenses. It's a $5,000 boost to profits. You take away your income taxes, which is 25% of that number, and that gives you your net income. That's the multi-step. Okay, that's the multi-step. For your comprehensive, what you're going to be doing is taking your net income that you just calculated. And in this case here, we had other income that needs to be added. Okay. I'm not emphasizing the comprehensive income statement too much. It's more that multi-step. Okay, so this we've already kind of gone over in Learning Objective 1, but we'll do it again in here, Learning Objective 5, because here they're actually asking you to calculate the cost of goods sold by using the very good old-fashioned periodic inventory system. Okay, and it's actually quite it's quite easy if you think about it, and it will get easier. Right, the store starts with a beginning inventory, so that's the first number. Then the store is buying all types of new goods to put in the store. That's the cost of good purchase. These two numbers together gives us the total cost of everything that's available for sale. At the end of the period, we take a look at what's left in inventory and subtract it out. Whatever is not there is our cost of goods sold. So we've seen this chart before, way back in Objective 1 that I went over with you. And this is what it looks like in an actual statement form. When they actually look at cost of goods sold, they start with the beginning inventory. They add their net purchases, but as you see, it's purchases minus returns and allowance minus discounts, and you have to add freight, right? So this we went over in Objective 2 as well, Learning Objective 2. So that means that we purchased 320,000 to add to our 36,000 inventory that's there. So we have a total of $356,000 of inventory that's available for sale that year. At the end of the year, we know we have $40,000 of inventory left. So the rest is our cost of goods sold. And that's all they're asking you to do here in this do it exercise. Figure out the cost of goods sold using the good old-fashioned periodic system. And let's rock and roll with Aerosmith's company here, showing a bunch of data. And they want you to do two things. They want you to compute the cost of good purchased and the cost of goods sold. So again, everything's gonna start with beginning inventory. So that's the first thing. Then the cost of good purchases is your purchases minus your returns and allowances, minus your discounts, plus your freight, right? That's the total amount. You add your beginning inventory to that total, and you subtract out your ending inventory, and you get cost of goods sold. So that's what your solution shows. Beginning inventory all by itself, purchases, less returns, less discounts, plus freight. So that's the total purchases. Total purchases plus your inventory at the beginning of the year gives you your total goods available for sale. At the end of the year, you look at what you got in inventory, subtract it away, and that is your cost of goods sold. So they want you to do that as well. And it's relatively straightforward. There's nothing big about this. And now we get into something very exciting in my view. We're actually going to be doing some financial analysis. Oh my God, I need a drink. Just stuck with spring water, so that's good enough for me. So we're going to look at two things. Learning Objective 6 introduces us to two very important pieces of financial analysis that we do here. One is we look at the gross profit something called the gross profit rate. And then we look at the net profit at the very end and calculate what we call a profit margin. So let's do one at a time. The very first one we're going to do is the gross profit rate. And it's simply a percentage. It's simply a percentage. Remember, all the ratios are comparison of two numbers, right? So in this case, we're going to look at the gross profit of the company and compare it to the net sales. That's it. That's all it is. That's the gross profit rate. Gross profit divided by net sales. That's it. Very, very simple. And this talks about what type of markup that the company is adding. Remember, they got to buy this stuff first. Then they have to increase the price. They have to mark it up to sell it to the customer. So that's basically what the gross profit rate tells us about. How much are they doing that? So here's an example. Remember, here's your formula. Gross profit rate is the gross profit over the net sales. That's it. Here we have our beautiful REI company, and we're going to be looking at 2014 data. It has a gross profit of $960,129. We got this from that multi-step income statement. And we divided it over the net sales of $2,217,131, which again, we also got from the multi-step income statement. So this information comes directly from the income statement, no other place. When you compare these two numbers, it's going to come out to 43%, which means that they have a 43% gross profit margin, or gross profit rate on their products. A little better than the previous year, but roughly about the same. Well, how does that compare to Dick's Sporting Goods? When you look at Dick's Sporting Goods information for the same year, 2014, and you put its gross profit over its net sales, Dick's only is working on a 31% gross profit rate. Okay, a smaller gross profit rate than REI. How does it compare to everybody in the industry? Remember what the industry is. The industry is a group of businesses that are doing basically the same thing. In this case, selling sporting goods, sporting goods retailers. Well, the average within the industry, the average gross profit rate is about 34%. So in that sense, Dick's Sporting Goods is a little bit below what the industry average is. And REI is much higher, has a much higher gross profit rate than the industry average. Okay, so this is one that you're going to be calculating, and a very important one. Matter of fact, you hear this all the time on Shark Tank. If you watch Shark Tank, they're going to want to know what the gross margin is. You know, what do you gross? What's your margin? They ask this question almost all the time if you watch the show. So it's very important. The second one looks at the amount of net income, right, which is that bottom line number, the net income, compared to the sales where it started with. So we simply look at it as a percentage of the dollar of every sales dollar that resulted in a net profit to the company. Okay. So let's take a look at how that works. Again, we're still looking at the income statement, but now we're looking at the net income, that bottom line number compared to the net sales, the same net sales we looked at in the gross profit rate. For REI, our 2014 numbers show a profit of $44,118,000 over sales of $2.2 billion roughly. So in other words, 2% is their profit rate. What does that mean? 2% of every dollar is their profit. 2 cents out of every dollar in sales is their profit. Okay, that's very low. So for every dollar they collect from the customer, after they pay for all these expenses, they're only keeping 2 cents in 2014. How's Dick's doing? Well, as you see, much better. Okay, Dick's Sporting Goods keeps 5.4% of every sales dollar as a profit. So that's roughly a little over 5 cents out of every dollar that the customer gives them is going to end up on their bottom line as a profit. Much, much higher than REI, and also higher than the industry. Also higher than the industry. So Dick's might not have a very good gross profit rate, but bottom line, they're keeping more of that money, more of that sales dollar than their competitors for the most part. So this is very, very good. Very, very good. When you look at the do it exercise here for objective 6, we're only looking at the gross profit rate and what we call the profit margin, which back in the day we used to call the net profit margin. But anyway, it's the same. So again, the gross profit rate, gross profit over net sales, profit margin, net income over net sales. Here we have a company, Rachel Rose, and this is the information for 2017, and for 2016 here, both for sales, etc. So they're asking us, first of all, what is the gross profit rate? So let's take a look at the gross profit rate for each of these years. So what is the gross profit rate, right? It's the gross profit divided by net sales. Well, they give you the net sales here. They don't give you the gross profit. But how can you calculate a gross profit? Net sales minus cost of goods sold will get you a gross profit. So here you're going to have to know how to calculate some basic stuff. So the gross profit margin, the gross profit rate, as you see for 2017, is 80,000 of sales minus 40,000 of cost of goods sold, which gives you a $40,000 gross profit divided by the 80,000 in sales. So it's a 50% gross profit. And in 2016, they had 120,000 of sales minus cost of goods sold of 60, which means their gross profit was 60. 60 over 120 is also 50%. So they're working on very, very high gross profit rates both years. Well, what about their net profit margin? Net profit margin, let's take a look. Remember, net profit margin is the net income compared with the net sales. Net income on the top, net sales on the bottom. So as you see here, that fraction is going to look like this: 18,000 of net income over 80,000 of net sales in 2017. 22.5% of every dollar that they collect in sales is their profit. That's excellent. In 2016, they had $20,000 in net income on 120,000 in sales, which means 16, almost 17 cents out of every dollar ended up being their profit. So even though they had less sales in 2017, they're a much more profitable company. They're keeping a lot more of that sales dollar as their profit, okay, which is important to know. Okay, so that is the overview for this part of chapter 5. Are there any questions?